Hi everyone. While our team takes a few weeks off in August, we're using this opportunity to revisit some episodes from our archive. This week we're going back to an issue we first heard about on the podcast a few years ago. It's about a secretive international legal system that protects fossil fuel companies, and that many experts are worried could jeopardise efforts to protect the planet from climate change. Since we last delved into this shadowy world known as Investor-State Dispute Settlement, or ISDS, a number of countries have withdrawn from some of the treaties being used by investors to sue states over their climate policies. So we're returning for an update on this important legal front line in the battle to keep fossil fuels in the ground. I'm Gemma, Ware, and this is The Conversation Weekly, the world explained by experts. When Kyla Tienhaara first found out about investor-state dispute settlement, she was incredulous.
I was really shocked that I had never heard of it. And I think that's the usual reaction whenever people find out about this system is, how have I never heard of this before?
Today, Kyla is an assistant professor at Queen's University in Kingston in Canada, where she studies investor-state dispute settlement and its impact on environmental and climate policy. ISDS is a form of private litigation or arbitration that allows a company to sue a country if that country is signed up to an international investment treaty that includes ISDS. Some of these treaties are huge, multinational ones. Think about what used to be called NAFTA. But others are just bilateral treaties between two countries that include this form of dispute settlement. Kyla is one of a number of academics who've been voicing concerns about the whole ISDS arbitration system. She's worried about how it could be used by companies to sue governments that take climate actions which harm the bottom lines of fossil fuel investors, such as stopping oil drilling or closing a coal power plant. So how did you get interested in researching these opaque international treaties and this, quite complex and very secretive bit of international law?
Yeah, so I'm not a lawyer, so it always is a bit funny how I managed to stumble into this. It was quite a long time ago. It was around 2005. I was working on my PhD, and I was supposed to be working on forest governance and looking at sort of international cooperation on forests. And I was looking at a case study in Indonesia, and I came across this news article that was about all these mining companies that were threatening the government with, hundreds of millions of dollars in legal claims if they didn't backtrack on a new policy that banned open pit mining in certain types of forests that were protected, basically to protect groundwater resources. But I understood nothing about what these legal claims were. I was like, it's not in the Indonesian courts, so what is this system where this is happening? And I just kind of got hooked and started digging into it, and completely abandoned my PhD on forest governance and took up something entirely new and spent some time in Indonesia actually digging into that case a bit more. The sad part is that the government did backtrack and allow the mining companies to proceed. But then in the course of all that too, I realized that it wasn't just Indonesia facing these cases. My own country, Canada, had been facing these cases for a couple of years over environmental policy.
So tell us about the history of these clauses and these treaties. When did they start getting used and why?
So the treaties that allow for ISDS go back to the sort of immediate post-colonial period. And it's really important that people understand the system really is an extension of colonialism. It was really intended in the first instance to protect the interests of multinational companies from the global north when they were operating in these newly decolonized parts of the world. And so that asymmetry still exists. The vast majority of these treaties are between a developed and a developing country. The investment only flows in one direction usually. So that means that the risk is all on the developing country side. And developed countries are mainly immune unless they get into these bigger regional or multilateral agreements. Then we get into the late 90s and we have the North American Free Trade Agreement, NAFTA, which had Canada, the US, and Mexico. And we have some creative lawyers who started to realize that these vaguely worded clauses in the investment chapter of NAFTA could be used to challenge forms of regulation that honestly the governments never anticipated these types of cases. Canada and the US were very clear that they expected this chapter of the free trade agreement to be used against Mexico. The concern really is what happens if a government completely takes over, nationalizes, or expropriates an investor's property.
That's the argument for them, isn't it? If you're a company investing in a country that doesn't have the kind of legal system that you think is going to protect you, then these clauses are meant to protect you.
Exactly, because in the early post-colonial period, there was, nationalizations occurring, and we can all debate whether or not we agree with those, and who should have sovereignty over natural resources and so forth. But that was the original argument, and that these countries didn't have well-developed court systems where investors would be able to make claims. But it has just morphed beyond all recognition, really, of what the original intention of the treaties was. And that's due to a lot of creative lawyering and the fact that the system is really stacked against states.
It's been pretty standard for ISDS clauses to get added into international trade agreements and treaties, and they're not usually the focal point of opposition. But there have been a few instances where ISDS cases became big news. One pretty notorious case started in 2011 in Australia. So the Australian government decided to introduce new rules about plain packaging for cigarette packets. This meant that companies could no longer have their logos or even any design at all on the front of a cigarette packet. Now, Australia decided it wanted to do this to make smoking less appealing, but Philip Morris, the cigarette manufacturer, said, hang on a minute, this is going to impact our sales. So they used ISDS to sue the Australian government. Australia eventually won on a technicality based on the way that Philip Morris actually brought the case. But the whole thing led to a lot of opposition to ISDS clauses in Australia. And actually, the current Labour government in Australia has said that it won't agree to future ISDS clauses, and it actually wants to renegotiate any deals that have got them in there. That case was about tobacco, but more recently, ISDS disputes have begun emerging which are directly linked to decisions countries are taking to move away from fossil fuels. Kyla told me about one of these cases, which is very close to home for her, involving Canada, the United States, and the Keystone XL oil pipeline.
This case originally started back in 2015 when the Obama administration, in the lead up to the Paris Agreement, said, we are not going to provide the permit for this big pipeline that's going to carry the most awful type of oil from a climate perspective, tar sands oil from Alberta in Canada through the US. And the company launched a $15 billion case under what was then the North American Free Trade Agreement, or NAFTA. Then Trump came to power and said, we'll provide the permit. And so the company dropped that dispute. Fast forward a couple of years, and we have the Biden administration, and he immediately on coming into office revoked the permit. So the company again launched a $15 billion dispute.
NAFTA was replaced in July 2020 by a new US-Mexico-Canada agreement, which contains some limited ISDS provisions. TC Energy, the company behind the pipeline, took the US government to an arbitration tribunal. But in July this year, it emerged that the company had lost the case. Now, these tribunals are very secretive, and the decision hasn't been made public. But it appears it was because the panel of judges ruled that Biden had cancelled the pipeline in 2021, after NAFTA was replaced. But that's not all the US government is fighting over the pipeline decision.
In addition to TC Energy, which is the company that has launched that dispute over Keystone XL, the Alberta government, which had very foolishly invested very late in the day when many people were very aware that Biden was likely to cancel the project, and seemingly betting on the fact that they hoped that, I guess, Trump would be reelected. So Alberta invested a whole bunch of money into the project, and now they are also taking a claim against the US government, which is quite bizarre.
This Alberta government case is ongoing. Kyla's big concern about ISDS is what it could do to hold back government action on climate change. She told me about a concerning clause that often appears in these international investment treaties.
The really problematic clause is this one called fair and equitable treatment. I mean, it sounds fine, right? Like everybody believes people should be treated fairly, treated equitably. But it's basically morphed into this idea that investors have legitimate expectations about what they're going to be able to do when they invest in a country, and changing policy, changing science, kind of be damned. They should be able to have things go as they planned. And so that's being used in cases now around climate, where the investors were saying we had a legitimate expectation that our coal plant or our pipeline was going to be able to have like a 30-year life or whatever. And now you're saying that it can't. So you've breached our legitimate expectations.
If a case comes before an arbitration panel, the money is key. Any decision on compensation hinges on what's called loss of future earnings. It's not always about how much money a company has already invested in infrastructure, say an oil well. It's about their future earnings, what profits they might make from oil in the future, and that could be a lot more than they spent building the oil well. If we stick with oil, the oil price might also fluctuate massively depending on the global economy. A couple of years ago, Kyla and her colleagues decided to try and figure out just how much money we could be talking about here. They began to calculate how much money countries might get sued for if the world is really trying to keep warming to below 1.5 degrees Celsius.
In 2021, the International Energy Agency came out with this big report called Net Zero Emissions by 2050. And it basically modeled a scenario for what needed to happen in order to keep below 1.5. And said no new oil, gas, or coal. And it's important to recognize the IEA is not some left-wing environmental group. It's a very conservative organization. And so for it to say fossil fuels have to stay in the ground now was pretty significant.
Kyla and her colleagues at Boston University used the IEA's statement as a cutoff point in their study. They assumed that all existing oil and gas projects would need to be cancelled if governments wanted to stay within 1.5 degrees of warming. They used a global database of existing oil and gas concessions and looked at which ones were subject to some kind of investor-state arbitration clause.
But for me, the most important part about that study was not the big headline of 340 billion, but the distribution of the risks amongst different countries.
So which countries are more at risk?
So what really stood out for me is that there are some countries like Mozambique that are highly vulnerable to climate change. They're also not overflowing with resources to defend themselves in arbitration. But my main concern about these types of disputes is that countries like Mozambique are going to look at a threat and just be like, no way, we cannot afford to lose that much in an arbitration.
You've talked about what you call the regulatory chill that these kind of cases can have on countries. So what does that chill look like in practice, and why are you so concerned about that part of this?
Yeah, so the chill part has been what is most interesting to me from the beginning. I mean, the people in the legal discipline tend to focus on the cases that actually happen and sort of going through and understanding how the arbitrators came to the decision and so forth. But for me, it's always been, what are the cases that didn't actually get to arbitration? When did an investor just threaten a dispute and, the government wanted to make it go away, and so either rolled back the policy or delayed action or something like that. There is some preliminary evidence, at least, that this is happening in the climate policy sphere. So we have one case, company called Vermilion threatened France when they came out with an oil and gas phase-out plan, and subsequently the government did change the oil and gas phase-out so that those with sort of existing concessions would have more time to be phased out. And then most recently, a journalist was able to get the New Zealand climate minister to actually say, our phase-out plan wasn't as ambitious as it could have been because we didn't want to have to deal with investor-state disputes. So this is really concerning. Again, critical decade for climate action. We don't have time for delay.
Another big climate ISDS case involved a UK-based oil company called Rockhopper Exploration. In 2017, Rockhopper sued Italy after the government decided to suspend exploration licenses for all offshore oil drilling within 12 nautical miles of the coast. This affected Rockhopper's investment in an oil field called Ombrina Mare off the coast of Abruzzo in eastern Italy. The case was launched through the Energy Charter Treaty, an international investment treaty covering the energy industry. After years of arbitration, in August 2022, a tribunal ordered the Italian government to pay €190 million to Rockhopper, plus interest at 4%. Rockhopper's share price more than doubled on the news. Italy appealed to have the ruling annulled, and a decision is expected later in 2024. I asked Kyla for her take on the Rockhopper ruling.
Unfortunately, I wasn't particularly surprised, but it is still really disappointing. So I'm really concerned that this is going to have a chilling effect on other countries that are considering similar actions in terms of banning oil and gas drilling. So what Italy did is very consistent with the climate science, even though it was It really came out of concerns about the local environment and so forth. And now we have this arbitration tribunal saying if other countries do that sort of thing, they should expect to have to pay hundreds of millions or even billions of dollars to oil companies to compensate them for this. It's just crazy.
The decision in Rockhopper's favour came even though Italy actually withdrew from the Energy Charter Treaty in 2016. But because it withdrew on its own, without the agreement of the other members, Italy is subject to a sunset clause. This means it can still be taken to arbitration under the treaty for 20 more years after its official exit, so until 2036.
And that means that any investments that existed prior to the termination of that treaty still get protected. And in the context of climate change, this is really problematic, right? Because this is a critical decade for action on climate. And we have all these treaties that really we should terminate. But if we don't get agreement from everyone on doing that, then the sunset clauses are going to protect these fossil fuel investors.
When I first spoke to Kyla in 2022, opposition was already mounting to the Energy Charter Treaty. But since then, a lot has happened, including a decision by the European Union to withdraw from the treaty. So I called Kyla up a few weeks ago in early July for an update. Welcome back, Kyla. It's good to speak with you again.
Thanks so much for having me on again.
So there have been some really big developments since we last spoke. And one of them is that a number of countries, including the UK, France, Spain, the Netherlands, have actually withdrawn from the Energy Charter Treaty. And then at the end of May this year, the Council of Europe also decided to exit the ECT too. So tell me how significant a moment this has all been.
Yeah, I mean, it's really exciting. And on the one hand, it is a huge deal. Even though it's only one treaty, the Energy Charter Treaty, the ECT, has a lot of members. So this development's actually equivalent to quite a large number of bilateral investment treaties being terminated. It's also significant because the treaty is protecting a lot of fossil fuel investment. So it's really great to see that happening. On the other hand, there are still a lot of questions about how many countries will leave. I mean, you mentioned there's quite a few and really significant countries have decided to leave, but there's still ones that seem to be sitting on the fence. There's also questions about what's going to happen to the ECT after all these countries have left, and also what the impact of the so-called sunset or survival clause. And so this has been a big thing that's been kind of hanging over the exit because 20 years is obviously a critical time period for climate action. So we can't really afford for fossil fuel investors to still be bringing cases in that 20-year period.
Where we are right now, it means that any of these countries that have left the ECT in the last couple of years, they are still on the hook for 20 years worth of claims against them.
Yes. So the withdrawal takes effect after 1 year. And you've got this sunset clause, which only applies to existing investments. So if there was any new investment made, that wouldn't be protected. But still, we've got a lot of existing investment where disputes could potentially arise. So that sunset clause is a tricky issue, and I do hope that the countries look at ways to try to nullify it.
Kyla told me it's still not clear what's going to happen to the ECT itself, a modernisation process that had begun a few years ago but stalled as countries started withdrawing is now back on the table. She says it's possible a few EU countries might actually decide to stay. That's because the modernisation could include a carve-out for disputes within the EU. This means an investor from one EU country, say Finland, couldn't sue another EU country, like Sweden, under the ECT.
There is going to be a vote probably sometime this year on the modernization of the agreement. Whether or not the treaty is going to be able to continue and survive without the support of the EU and these major European countries is sort of an open question. But there's also this additional complexity that companies could potentially get around any of these arrangements that are made by restructuring their investments through a non-EU country that is remaining within the ECT. So the country that comes up most frequently as a potentially attractive option for investors is Switzerland. So let's say, for example, you're a German investor in the Netherlands. You're very likely hearing advice right now from law firms. I've seen this on legal websites saying you should restructure your investment through a third country. So establish a subsidiary, for example, in Switzerland, and do this before the German withdrawal from the ECT takes effect, and then you'll have the protection of the sunset clause going forward. Of course, it's possible that Switzerland will also eventually leave the ECT. We can hope that's the case. But the point is fossil fuel investors and other investors are really going to be looking right now for ways to keep the door to ISDS open. I think it's really important not to downplay the significance of the ECT exit, but also to be clear that this is one treaty out of 2,500 plus treaties. And I'm really focused now on the next step. So if the European countries and the UK, they really need to act consistently about ISDS and follow up on this exit with plans to modify or terminate their other treaties with ISDS, particularly with countries in the global south. Climate change is a global problem, and so is ISDS, and we need to deal with it in a holistic manner.
I asked Kyla if, despite the growing awareness around ISDS and the Energy Charter Treaty, there are any significant new climate-related cases that have been brought since we last spoke.
There's a really big pair of cases launched last year in Australia and late last year. The company Zeph Investments, which is actually owned by an Australian billionaire, Clive Palmer, but it was structured through a subsidiary in Singapore. This company was pursuing thermal coal mining lease in the Galilee Basin in Queensland, and this would have generated 1.58 gigatons of carbon dioxide emissions, which is roughly equivalent to what Australia emits over 3 years. And there was this really landmark court ruling that recommended against the issuance of the mining lease because the project would have had, quote, unacceptable climate change impacts. The Queensland government decided to follow this recommendation and rejected the bid for the lease. One of the claims was for $69 billion Australian, or about $45 billion US. They brought another claim under another treaty for over 41 billion Australian. And then they also have a separate claim over an iron ore project that isn't really climate relevant, but it's still interesting because it's a $300 billion claim. So in total right now, one company is suing Australia for over $400 billion Australian. So even if they don't come anywhere near winning that much, it's just, I find it shocking that a company is able to do this.
Neither of these cases were brought under the Energy Charter Treaty. One is via the Singapore-Australia Free Trade Agreement, the other through a free trade agreement between the Association of Southeast Asian Nations, or ASEAN, Australia and New Zealand.
That's what I was trying to say. The ECT is a really significant win, but we do have all these other treaties to deal with.
When I first spoke to Kyla, she told me that countries had begun to realise what's at stake with these kind of treaties, and with ISDS more generally, and they were beginning to fight back. Some had already begun cancelling bilateral treaties containing ISDS clauses, while others were attempting to renegotiate them. Countries like South Africa have refused to put these kind of clauses in any new international trade deals, and some countries have specifically fought to put clauses into these free trade agreements that prevent companies from suing them over climate action. So I asked Kyla what other new forms of resistance are taking place.
So there was a really interesting story that played out in late April of this year in Ecuador. The country currently has a pretty right-wing government, and at the moment they really are keen to sign trade agreements and keen to include ISDS in those agreements. And in particular, the government was in negotiations with Canada for a free trade agreement. And the Canadian government was quite open about the fact that the mining industry wants access to ISDS and that they are willing to act on behalf of the mining industry and try to get ISDS in the treaty. And Ecuador seemed to want that as well. But interestingly, ISDS is prohibited under Ecuador's constitution. So what the government decided to do was to hold a referendum on a number of topics. A lot of them had to do with security, nothing to do with ISDS, but they slipped in this one question on this constitutional clause, basically trying to get it removed. Thankfully, civil society groups, both in Ecuador and around the world, very quickly mobilized. They had a very short amount of time to get the word out about this, but they did. And I'm happy to report that the Ecuadorian people agreed that ISDS is a bad thing, and 63% of those that voted in the referendum voted to keep that clause in the Constitution that prohibits ISDS. So that's another great win. It's a great example of people pushing back against the system, but it also shows that there's this constant flux. You see when governments change, the position changes, and the anti-ISDS movement has to constantly sort of be on their toes. Just because you have a win at one point doesn't mean you're going to be able to hold on to that. Another example is Honduras quit the International Center for the Settlement of Investment Disputes, or ICSID. This is part of the World Bank Group, and it's the most used forum for ISDS. The country really did this in response to several multi-billion-dollar ISDS claims. And the interesting part about this is not just that they've left ICSID, but this whole situation with Honduras has galvanized quite a movement in the US, and a lot of Democrats are now calling for ISDS to be removed from the Central America Free Trade Agreement, or CAFTA, and other regional free trade agreements. And if the US were to actually take this step, it would be a very big deal. I mean, US investors are big users of ISDS.
Kyla recently wrote an op-ed article actually calling for a mass withdrawal of ICSID, described as the World Bank's corporate court. She said it came after she read research about how deeply involved the World Bank was in establishing ISDS in the first place.
I've been looking at the rhetoric from the bank about a just transition away from coal. And the inconsistency here is just so striking, because on the one hand, you have the bank saying that a country like Indonesia, you have to phase out coal. It's really important for addressing the climate crisis, and you have to do this in a just way. But then at the same time, many of the coal power plants that need to be retired early in Indonesia are owned by foreign investors, and they're protected by investment treaties that provide access to ISDS in ICSID, in this World Bank Arbitration Forum. I just don't feel like ICSID fits within the World Bank's mandate. Now, several countries have withdrawn from ICSID. I mentioned Honduras, and Bolivia had done. Ecuador, unfortunately, left and then rejoined with the change in government. But there are several other countries also that never joined in the first place. Unfortunately, it's not a panacea if a country leaves, because there are other avenues that investors can use to pursue ISDS cases. But I still feel like it would be a major symbolic blow to the system if there was just this mass exodus from ICSID.
Thank you so much, Kyla. It's been really fascinating getting this update from you, and it seems like a lot's happened since we last spoke. Maybe we'll have to speak again in a couple more years and see where we are.
Yeah, it's getting hard to keep up, but that's great because a lot of the developments are good. So thanks a lot for the chat.
Yeah, thank you. That's it for this episode. To hear more about the Rockhopper case in Italy, please go back and listen to our original episode on ISDS from 2022. We'll put a link in our show notes for where you can find it. It also contains an insider's look at how arbitration tribunals actually work. This episode was written and produced by me, Gemma Ware, with assistance from Mariwany. Sound design is by Eloise Stevens and Michelle Macklem, and our theme music is by Neeta Sarl. Our global executive editor is Stephen Kahn. You can connect with us on Instagram at theconversation.com or email us directly at podcast@theconversation.com. Do sign up for The Conversation's free daily newsletter by clicking on the link in the show notes. And if you like what we do, please support our podcast and The Conversation more broadly by going to donate.theconversation.com. Please also do rate and review the show wherever you listen. It really helps us reach a wider audience. Thanks for listening.